The United States plans to use inflation to erase its debt burden. The rich follow this exact same playbook, and the best part about all of this is that once you know what they do and how they do it, you can do the same thing too. Right now, the United States government has over $34 trillion worth of debt, but that's a meaningless number, means nothing, so let's put it in terms that we actually understand. Right now, per year, they're paying about $1.2 trillion just to service the debt. What does it mean to service debt? That means how much does it cost you just to pay the interest portion on the debt, which means if you want to keep the exact same amount of debt and you want to not pay it off, you don't want to grow new debt, how much are you paying in interest just to keep that debt? Right now, that number is $1.2 trillion. But the problem is they have to borrow new debt in order to pay that $1.2 trillion. So the national debt number grows, which means next year, that number will go up to $1.7 trillion. Why is that a problem? Well, let's take a look at their income. United States total tax revenue is right around $4.5 trillion, which means that pretty soon here, every single dollar the US government takes in taxes will be used just to keep the debt, just to pay the interest on the existing debt, which means all other spending has to come from just borrowing. Borrow more just to pay for the debt, which means you got to borrow more to pay for that debt and borrow more, and it's an endless cycle that eventually just means you're insolvent and you default. If any individual is in this situation where 100% of your income goes to just pay the interest on your debt, eventually the lenders stop lining up to lend you money. You can't afford those debt payments anymore and you default. But obviously the United States government is not just a normal borrower. They can choose to get out of this anytime they want. And in fact, they've been in this exact same situation they're in right now before. So if we want to know how they're going to handle it right now, we just have to take a look at how they handled it last time. GDP is the size of the economy. And so for the government, if you want to look at how much leverage they have, you look at their tax base, which is the economy, GDP, and you see how big is the economy where they pull their taxes from compared to their overall debt burden. Right now, it's around 120%, which is very, very high, but we have been here one time before. If we zoom out, we can see the last time we were here was the 1940s. And what you're taking a look at here is the long-term debt cycle. From about 1940 through about 1980, the United States government was deleveraging, again, just its debt as compared to GDP through inflation. During that entire time, inflation was rising, rates were rising, and the government deleveraged. The economy grew compared to the amount of debt that the government had. Then for the next 40 years, from about 1980 through about 2020, the government did the opposite. They increased their leverage, all the while inflation was going down. We had disinflation and rates were dropping as well. This happened because you can increase your total debt load while not having to pay more for that debt if interest rates are going down. If your interest rate on your debt is 10% and then it falls to 5%, you can afford to double the amount of debt that you have and still have the same monthly payment. And that's what's been going on for the last 40 years with the US government. As rates have been falling and the economy has been growing, they've been loading up with more and more debt, and they've been able to afford it so far, but now they've kind of peaked out again at this 120% debt to GDP ratio, which means that if we project this chart forward from about 2020 through about 2060, we're probably going to see a period of time that will be just like the 40s through the 80s, which is deleveraging, again, the government deleveraging their debt as compared to the GDP through inflation. So how did they do this during the 1940s? There are a couple of things that they did. Number one, the Federal Reserve engaged in yield curve control, which meant they held interest rates on government debt artificially low. They made sure the interest rates on government debt stayed at that rate by buying as many of those bonds as was necessary to keep the interest rates there. This meant the government could borrow as much as they wanted at that rate, which basically meant money was getting lent into existence. The federal government spent that money into the economy, especially on war efforts, and that jacked up prices and inflation went through the roof, which meant the real rate of inflation was very high. The real interest rate was steeply negative. The next thing that happened was a very long period of inflation rising, and along with that, you can see here, interest rates rose over that time period as well. This is the 10-year government treasury rate, and you can see for about 40 years, it was going higher and higher on average. And this entire phase of the long-term debt cycle ended with a bang. That last decade in the 70s was when we delinked from gold, ended with a bang with big inflation and much higher rates as the government spent a bunch of new money into existence and no longer had to worry about that pesky old little gold standard that it ended. The next phase of the debt cycle that started in 1980 was the exact opposite. During that time period, it was marked by growing leverage. You look at the debt to GDP ratio, you can see the government's leverage was growing that entire time. It was also marked by disinflation. During that time, the rate of inflation was falling, and you also had falling interest rates. rates, which meant the entire economy as well as the government was able to load up on more and more and more debt, and they were able to afford it easier and easier and easier because the cost of that debt, the interest rate, was falling and falling and falling. By the way, all of your common sense investing that you've ever heard from your standard financial advisor and your basic online financial guru that talks about dollar cost averaging into SPY, really that's just based on data that has existed since 1980. It's all based on one phase of the long-term debt cycle that has already ended. That spray and pray method is probably not going to be the most effective way to grow and protect your wealth over this next phase of the debt cycle. Instead, you should probably be looking at what worked best during the last time we had a debt cycle that looks like what we're entering into right now. So in practice, given what we understand about how the government dealt with this in the 40s and the opposite that happened in the 80s, what are they likely to do now? Well, number one is probably keep rates higher to fight inflation. If we take a look at everything that Powell has said about inflation for the last year and a half, he's always maintained that they will cut rates when and if the inflation rate comes down low enough to justify that. Now, at the end of 2023, basically the entire market was expecting that this would happen sooner rather than later. But as time has gone on, now the market is realizing, no, that's just not happening. And Powell has reiterated yet again that inflation is not where they need it to be and that they will not cut rates until or if it does so. Number two, the Federal Reserve, while keeping rates high, is going to do something different this time, and they're probably going to return to QE, quantitative easing, to make sure that the government doesn't default. So what is QE, QT, and why does it affect government borrowing and defaulting? Well, remember what I said at the beginning of this video about the pickle that the government is in, $34 trillion in debt, $1.2 trillion spending just on the interest on that debt this year. Next year, that's going up to $1.7 trillion. At the current pace, it's going to get to the point where every dollar that they take in taxes is going to be spent on just the interest on the debt. You get to that point and basically you default, as long as you're not the US government. So what the US government will do is it will lean on the Federal Reserve. So the Federal Reserve has something called a balance sheet. Federal Reserve's balance sheet, which is currently worth a little over $7 trillion, is comprised of treasuries and mortgage-backed securities. You could think of this like a brokerage account, and those are the two assets that they hold. When this chart goes up, that means they are printing money to buy assets like treasuries and mortgage-backed securities. That cash goes into the financial system to replace the assets that they bought. That cash then can be used for other things, and usually the banks that sold those assets to the Fed will then just turn around and take that cash and do the same thing with it, like buy another treasury, loan it to the US government again. But when the Federal Reserve's balance sheet is going down, that means the Federal Reserve is doing the opposite, which we called quantitative tightening, or QT, and that means the Federal Reserve is letting assets bleed off of its balance sheet. Remember, treasuries are debt. So for every treasury that the Federal Reserve owns, that's debt that the government owes to the Fed. And as the Federal Reserve's balance sheet goes down, that means that debt is getting repaid and not getting lent back out again. When those dollars get paid back to the Fed from the government, that debt just ceases to exist, and so do the dollars. The Fed doesn't keep those dollars or use them because any expenses that they have, they just print the money for. And for the last 2 years, as you can see, the Federal Reserve has been engaging in QT, which means that the government is paying debt back to the Federal Reserve, and the Fed is not turning around and loaning that money back to the government, which means the government has to go somewhere else to get those dollars from, because again, they've got to borrow the exact same amount of dollars that they just paid off and more in order to keep servicing their debt. And so step one is going to be to slow down the pace of QT, which Federal Reserve Chairman Powell just announced was going to be something they're thinking about doing soon, is slowing the pace of QT. The next step after that is going to be completely stopping QT, and they're just going to say some excuse like, hey, we've gotten liquidity in the financial system back where we wanted and conditions are sufficiently restrictive. We're going to stop QT, and their balance sheet is just going to flatline from there. But there's going to be a crisis, and it might be the commercial real estate crisis with all the debt getting rolled over in small banks, or it might be something else that's completely unpredictable. But at some point, the Federal Reserve will step back in and start up QE again, which means once again, they will be printing dollars to buy treasuries, which means they're loaning money to the government indirectly, and the government is spending newly printed money into existence. The net result of that will be that every dollar the government then starts spending once the Fed starts QE again means that that money has been printed into existence, which means those are new dollars floating around in the system, pushing prices higher more. But the Fed will still be needing to fight inflation, so that means higher rates for the rest of us while inflation continues to move higher. Sounds a little bit like what happened during the 1940s, doesn't it? higher inflation and higher rates. Now, the theory is that if the government does this, what's going to happen to the economy is it's going to grow. So GDP is going to increase, prices go up, wages go up, which means tax revenue for the government goes up, and they'll be able to afford to pay for all of the debt that they just created by stimulating the economy. The problem is it just doesn't work out this way in practice. For every dollar they borrow, it doesn't produce that much more money in tax revenue. And so they end up increasing their debt costs by a lot more than the increased tax revenue that they get, which means that this phase is very likely to end the same way that the last time we had this phase, which is with another inflationary bang. From the 40s through the 80s, they were trying this exact same playbook. And while they did deleverage, it still ended with a bang in the 70s with a massive inflationary boom. And that's exactly what we are likely to expect for this phase of the cycle, that it will end in another massive inflationary boom. We cannot decouple from gold yet again because we've already done that once. But what we can do is monetize a massive chunk of the United States government's debt with the Federal Reserve restarting QE like we've never seen before and buying 10, 15, 20, or $30 trillion worth of US government debt, effectively retiring that debt for the government. So all of the interest on that debt goes to the Fed, gets paid back to the government, essentially becomes no debt. Massive inflationary spike will happen, but it will result in a massive deleveraging as a result. Again, it's very important to emphasize that this changes the rules of investing. The more currency is debased and the more inflation you have, the more money goes into assets just to protect itself from debasement. This is the reason why we see valuations continue to go higher and higher and higher over the last 100 years, and those old rules of investing seem to no longer apply anymore. Because money doesn't care about profits, money doesn't care about value, money just cares about protecting itself when there's an entity that's just eroding it constantly at a faster and faster pace. This is why inflation doesn't just happen with goods and services, but it usually happens to assets first, because the big money knows it wants to protect itself, so it buys assets. But the good news is we can follow this exact same playbook. Once you see which side of the fence is greener, you can just hop over onto the other side. So step number one, increase your own personal money supply. Just like the government increases the money supply in order to try and increase its income relative to its debt, you can do the exact same thing. And the way that you increase your own personal money supply is by increasing your income. So for the vast majority of people watching this, I would probably recommend getting into a sales position. It's pretty much the only job like job that you can get that is not only protected from inflation, but actually directly benefits from inflation. When inflation is happening, it means prices are going up. So who benefits by prices going up? The people who are selling those things. And so when you are in sales, selling something with the price going up, you're getting a percentage of that thing that you are selling. It's good for you if the prices go up. Now, the caveat to this is that you will probably want to change industries once every couple of years because the skill that makes you money is sales, not that specific product or not that specific industry. The economy changes. That's just the nature of how the world works. So you want to hop from one to another just so you make sure you're always going to where the grass is greenest. And then for a small minority of people, the best way you're going to be doing this is to start a business, whether that's a side hustle or a main hustle, because when you run your own business, only you and the customer determine your income potential. You're probably going to have to learn a ton of skills that you've never learned before. Like when I quit my job as a stockbroker in 2019 and I started Heresy Financial, I thought I had all the skills necessary to start a business. It actually took me a year and a half before I made enough money to just pay the bills. I had to learn a ton of skills to fill in that gap before I started making real money. But that's step number one, which is increase your own personal money supply. Step number two is get rid of all adjustable rate debt immediately. We are in an environment where inflation is bottomed out. It is going higher. We're in higher for longer. Interest rates are moving higher as well because the government's not going to slow down anytime soon on its spending. And all that's going to happen through printing, which means higher inflation and again, higher rates. If you have adjustable rate debt, it will bankrupt you. That is the most dangerous thing that you can do, is hold debt at which you have no idea what the cost of that debt will be in the future. For most people, that's going to be credit card debt, but for a lot of people, especially if you bought a house in the last year or two, it might be your mortgage. Get rid of it immediately. It will crush you. Adjustable rate debt is the last thing that you want in an inflationary environment. And then step three, and this is the most powerful wealth building tool that you can use, is use fixed rate debt to buy assets that pay for the debt. Fixed rate debt because you know from the start the exact number of dollars that you're going to pay. When you use fixed rate debt to buy assets that pay for that debt, you're benefiting in a couple of ways from that inflation. Number one, you have an asset now that will go up in price from inflation, because remember what I said earlier, when inflation happens, money seeks assets to protect from inflation. So you buying those assets, you're going to directly benefit from that inflation. Number two, that debt will get easier and easier to pay off over time because the number of dollars that you owe back doesn't change. This is evident when we look at mortgages from 30 years ago and we say, oh, wouldn't that have been nice to have a $250 mortgage? Today, literally anybody could afford a $250 mortgage. And that's the power of fixed rate debt. You lock in the number of dollars that you're going to owe, and over time, as the money supply grows and the cost of acquiring that money goes down, it becomes easier and easier to pay off that debt. Number three, you have cash flow, because remember I said that asset is going to be paying for that debt. That cash flow itself is coming from a product, and that will go up as well, which means you can deleverage faster or increase your income faster to buy more assets quicker. And then number four, get wealth outside the system, because we have financial repression likely coming. If you take a look at this paper from 2015, this is the IMF advising governments around the world saying, hey, you're probably going to have inflation soon. And when you have inflation, wealth is going to try to flee, because when you have inflation, wealth doesn't like to have its purchasing power taken away from it by the government. So if you want to prevent this, what you have to do, you have to implement financial repression controls before the inflation happens, before you need it, because then the people will be used to it. So if you anticipate needing to use financial repression tools, might as well get them in place now so that they're actually effective once you need them. For us, that means get wealth outside the system now before you get locked down. Because by the time you need to get wealth outside the system to protect yourself from that debasement, you probably won't be able to. So you got to do it now before you actually need it. And of course, if you need help with any of this, that is why I created Heresy Financial University. That is my paid membership program where I teach you literally everything you need to know about how to make more money, investing, trading, growing your wealth, and protecting your wealth. If you need more information, the link is in the description below. As always, thanks so much for watching. Have a great day.